Hello, I'm going to introduce you what we do at Morata Capital. I'm Florian Morata. I've been building businesses in the last 15 years, including in software and in sales. I'm also working in geopolitics at the Strategic Intelligence Institute and at the EU Commission as an expert in geopolitics. And my friend is Joris Capot, 15 years expert in finance, CFA holder. We have been working together for a long time. And in 2024, we decided to create our fund to manage our friends and family money in the exact same way as we do manage our own money. And the way we manage our money is a bit different from other people because we are business owners and then we dig a lot deeper into how the companies is working in the inside and not just how the financial report looks. And we decided to create a kind of community minded group of investors with shared value, and in particular, the long term mindset, many decades ahead, and in particular, also on integrity. And for us, it means we are against harming innocent animals or the planet. And so that's how this fund was created. As EU regulated, we do have registration with Estonian Financial Supervisory Authority and Financial Intelligence Unit. And our strategy is essentially being 100% on equity, long only on large cap companies. We are mostly in tech, defense, and finance, even if it's not strictly bounded by this sector. We try to be about 50% exposed to the US and 50% exposed to European Union and other developed countries. We don't do countries outside this sector. We invest only in the long term. Ideally, our holding period is indefinite, but in practice, on average, is between 5-10 years, which requires, in our case, a lot of patience and discipline to find the right opportunities at the right price. We do differentiate ourselves by a much deeper customer intelligence. For us, it means understanding exactly what's going on in the mind of the customer, putting ourselves in their shoes, and in particular, understanding their goals, their constraints, their opportunities, their fears, and especially all the alternative product they can choose from competition or doing nothing. And so by putting ourselves in the shoes of our customer, we can understand better if the demand is going to continue to grow over decades or if it's going to wade. And it is particularly important in sector like tech, defense or finance because customer can swing very rapidly into something else if we don't experience through their own life. We are also paranoid. We focus first into everything that can go wrong. For us, a good opportunity is an opportunity with little downside and potentially high upside, but very important for us to make sure that we make sure that there is no factors that we did not investigate deeply. We don't want downside that will be surprising us. We also, like would do Warren Buffett, we investigate moat, durable competitive advantage. We have a specialty into high switching costs. We don't do much about brand and scale and others type of competitive advantage. We really focus on infrastructure installation and technologies. We want also to see growth. We mean by that that we look at companies that for the next 20 years have solid evidence that they can continue to grow and develop beyond being temporarily growing. For example, we don't necessarily like too recent sector. Let's take the AI or NVIDIA, for example. Even if I use on a daily basis this tool, for me they are relatively too young to be bet for the next 20 years, and it's difficult to say how for us how the market will evolve. We are more interested into companies that have a longer track record and that do not excessively depend on one particular technology like AI and NVIDIA, as I said. We also are looking for strong financial. For us, it means a survivable debt. And by that, we means we take the balance sheet, we apply very tough haircuts on many of the assets. We keep all the liabilities and we check if the company can survive a very, very difficult situation like the worst crisis we have seen in the past. And we also want to see a history of high returns, or at least the capability to having high return. And then we also look for companies having great managers, which means for us being capable, growing the company, being honest, otherwise we cannot trust them. Also, long term thinking with aligned incentive over the long term, because, for example, if half of their salary come from bonuses indexed on next year stock price, that's not very good for us. We look for a manager ideally who have skin in the game. For us, it means that they do have a sizable share of their own wealth in the company they manage. Last but not least, we look for reasonable prices. This is very important. For example, many of the great quality companies are overpriced. So we are not interested in such company. We look for ideally for normalized price earning of around 10. By normalized, I mean we go through the last 30 years of revenue and profit. We analyze what can stick, what may not stick, and we make a worst case scenario and we project that in this worst case scenario in the future. So for us, normalizing is already removing a lot of items from the existing income. And beyond that, we accept only a low price earning ratio, which means by being very, very disciplined into the price we buy, we try to minimize the risk of losing money on the stock we invest in. We usually find such opportunities in temporary setback, companies that are temporarily unloved. This is obviously by definition not often. The vast majority of the time, the good company are valued at full price, which is too expensive for us. But once in a while, some companies go through temporary setbacks, and that's when we may be interested to buy them. Usually we have like a list of about 100 company we know very well, and basically we wait that they are on the sales to buy them at good price and stay patient until they are at good price. Which also means that because we have a limited number of opportunity, we are quite concentrated between 10, 15 companies in the portfolio, which also means that we are occasionally volatile, and especially because a significant part of the portfolio is in tech. We may have important swings from one year to another, but for us, that's the price to pay to hopefully have a superior result over the long term by accepting temporary variation. We also avoid leverage, margin, or derivative, and this leads us all these criteria. That leads us to company like Microsoft, Google, Amazon. But these three, for example, they are great companies, but they are often way too expensive, so we cannot buy them very often. Then there is other companies that are often interesting, Samsung, Intel, sometimes PayPal, for example, was trading at very, very low price earning, while also having consistent and growing earnings and otherwise as a good quality company. MasterCard, excellent company, but often overpriced. Gartner FactSet, occasionally underpriced. Constellation Software, a great compounder. Sometimes the market doesn't love it, so that's the time we try to buy it. Accenture, Munich Re, sometimes we investigate finance and insurance. Wolters Kluwer for European service company. And then, of course, the defense part, I put only a fraction. Dassault Aviation, Rheinmetall, Saab, BAE System. These are only examples. This is not what exactly is in our portfolio, but this is the kind of company we keep an eye on. And when they are at a good price, and of course, when everything is still good in the company, we pull the trigger. So that's in a nutshell what we do. Feel free to contact us, and we'll be happy to share. We can find the contact information in the description of the video. Thank you. Bye-bye.